I think eventually that's what happens this whole next 10 years. I think people are underestimating commodities versus where we would be on just finance. Everybody's been loaded, Gary, for 40 years on financial assets, been the only game in town. Everything's about money, 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 money. And then all of a sudden it may turn to things, you know, like things. I want to own something. And I think you probably are going to see a lot more of that in the next 10 years.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Boehm. Today we have a fantastic discussion lined up, and we're fortunate to have with us Ted Oakley. Ted is a managing partner and founder at Oxbow Advisors, and he has more than 4 decades of experience. He's a frequent guest on Fox Business News, Bloomberg Radio, and many more outlets. He's also the author of 10 books. Ted, thank you so much for joining us today.
You bet, Gary. Good to see you.
Good to see you. Well, let's begin with the Fed. One insider recently stated the following that I would like to get your take on. I think we should all just acknowledge now that we operate within a fully managed financial system where the authorities have all the tools necessary at their disposal to ensure that we never have a 2008 style crisis again, or even a recession, or certainly recessionary conditions reflected in financial markets again. And so that the big risk now, they don't really exist in the areas of the market that most people typically look, but rather they're externalized to the political domain and to the social domain. Ted, is the Fed as omnipotent as this insider is suggesting?
Well, no. Matter of fact, if you go back to Greenspan, he thought he had it down too, you know, and then every Fed president since that time has thought they had, look, you know, right before things go haywire, you know, they will be saying that things are okay and it looks like everything's going to work out all right. And you have to remember, though, Gary, all these people are academics. I mean, they don't know anything about Main Street. And so we don't really listen to a lot of what they say because we feel quite certain they'll change it. And probably when they get in trouble, everything goes out the window. So, but the idea that you'll never have any economic cycles is ludicrous. I mean, that's a historical thing back to the beginning of time.
Yeah. So, Ted, the 2 largest economies on earth, the United States and China, are either softening interest rates or providing economic stimulus or both. And many other large economies around the world, they're also softening rates. What does all this mean for inflation and the price of real things?
Well, in the short run, this is what happens on these. I've been through a few of them. You know, the rates will go down, and you may even get a boost in financial assets for a short period of time. It's like I get another hit on dope, just one more for that night, and then the next morning, you know, you feel it. But what happens is the next time around, you know, your rates go down, people get excited. Hey, we're back in the run again. But then your next level inflation is higher. That's what Arthur Burns did. And he pulled the trigger too fast in the 70s. And by the time he finished, we had 2 more rounds of inflation, and they didn't expect it, much like they didn't expect this last one 2 years ago. So, you know, if they get in trouble, they'll lower the rates. There's no question about it, and they probably have to because of the government debt. But what we look for now is we're staying with the short-term paper mostly. Because now we're at the level where you can't really trust that long bond. I think people that are trusting it are being misled to a degree.
So, you know, one of the experts that I've recently had on Metals and Miners, he said to me that he thinks because of the box that the Fed is in, both to the downside and the upside, whether that be, you know, lower rates get higher inflation or raise rates and have higher debt servicing costs. And so, you know, in both directions, there's a problem. And he believes that we're going to see the cycles between Fed rate cuts and rate raises shorten because of this. Are you of that opinion?
Well, I am, because the Fed has this, everything's a stock market. And that started really with Greenspan, if you want to get right down to it. You know, he blew it up in 87 because he raised rates too fast and shouldn't have. And then, you know, you come along, everybody after him does the same thing. You know, it's just got to save the stock market. Well, you get to a point where your debt's out of line. This cycle goes real quickly now, and they are going quicker. And I think what happens is people won't be ready for it, though. On the other side, they'll think it's okay if they come in lower rates. I don't think they can lower them as low as they were before. I don't think there's any chance of that. But if they get afraid of the market or something like that, they'll lower them. But that's when you have to really be careful, because it'll make you want to reach out for some yield or something, and you probably shouldn't do that.
So speaking of yield, 3 weeks ago, the 30-year bond was under 4%. Today, it's at 4.48%, the last I saw. If you look at this in the context of the upcoming election, if Trump gets elected, the deficits are going to get bigger. If Kamala gets elected, the deficits are going to get incredibly bigger. Either way, issuance is going way up. You're going to get more inflation. So you kind of touched on this earlier, but is the last thing that we want to own a 30-year bond?
Well, in my opinion, it is. I mean, if you think about it, if you want to pay me $4.14 for a 30-year piece of paper, I'm going to make a 30-year bet, because it's non-callable. It's a 30-year bet, if I want to go that direction, that inflation will never go over, you know, 4.14. And I just wouldn't be willing to make that bet. And I've never found that buying, like, we trade that paper. Just to give you an idea, 4 or 5 months ago, right before they announced, we took a position, not a lot, 7% in the 30-year, and all we wanted was a trade. We got that trade and we left. And I think people have to realize, if they're going to be in those markets, they better learn how to trade.
Do you see a correlation as far as inflation is concerned, back to the 70s? You referenced Arthur Burns. We've had one spike up. There was 3, I believe, in the 70s. Do you see a correlation there?
Well, it's worse now, though, Gary, because what happens is, if you look at debt to GDP, it's worse now than it was then. So we don't really have any room at all. And I think the bigger part of that that's really bad is that we may not have anywhere to go with the bonds. And so the bonds will have to be, if you look at even now, they can't issue 30-year paper. Nobody will buy it. So they're issuing bills all the time, which is what we're buying. You know, we're buying 3 months to 2 year, but back then they were even then they were better off than we are today, because our debt to GDP is, over 100%. It's probably going to 120, 140. And if you look at history, your economy is basically going nowhere after that. Don't necessarily crash. They just don't go anywhere.
Yeah, and I think debt to GDP in the 70s was in the 35% range. So sounds to me, and I don't want to put words in your mouth, but sounds to me like you're expecting higher inflation for longer.
Well, I think eventually you have it. Now, where you could get it in here, let's say you got a market break or something, which you could easily do that, because we're very expensive on the stocks. And so if you got that, they're going to lower the rates. Now, where they take them to, I don't know, but you would guess they would take it down at least 200, 250 basis points from where that 5% is, and to try to get things going. Problem is that would also, when I say get things going, we're already in a big deficit situation. So we're already going, so to speak. We don't have any room. We have a recession right now. They would have to run 12, 14% deficits, which then we would really be in trouble, because we couldn't sell the bonds. The bonds would have to be sold in the U.S., and they might do something like they did in World War II or something, where they make you buy the bonds. But people say, oh, that'll never happen. You never know what happens with a government when they really need something. But yeah, I mean, I think eventually that's what happens this whole next 10 years. I think people are underestimating commodities versus where we would be on just finance. Everybody's been loaded, Gary, for 40 years on financial assets. Been the only game in town. Everything's about money, 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 money. And then all of a sudden it may turn to things, like things. I want to own something. And I think you probably are going to see a lot more of that in the next 10 years.
In your scenario there, your recessionary scenario where you said something like 12 to 14%, the other consideration is the tax revenues that would come in. That would dip so far down during a recession.
Yeah, and we don't, even now, our tax revenues don't cover anything. I think what people have to start to realize is, what do we look like? If we were just a company, would we buy the stock? And no, we wouldn't. If you look at our interest costs, they're more than just this year. They crossed over defense spending, which has been one of the number one things we spend on. But we've got these baby boomers locked into everything. They get Medicare, Medicaid, Social Security. It's all about the boomers. And the problem with that is that all of that's going to sort of converge on a spot here where it just makes it harder. Now, does that mean you have to sell everything and go hide in the backyard? No, but you need to understand that safety, a certain degree of safety, is something you need to think about.
So, Ted, everyone's been talking about the national debt issue for 30 years plus, and there really hasn't been a debt crisis implosion yet. While the numbers are vastly larger today, why can't they just keep kicking this can down the road?
Well, that's it, Gary. They can. I mean, we can be like Japan and just have the Fed buy up, the issue of the debt, and the Fed buy it up, and and just roll with it like that. You can do that. And what that does, though, is it crowds out everything else, and your growth ends up like Japan too. You're growing at less than 1% a year, and I think people think, well, we're just going to show up one day and the dollar's going to crash. We can't sell the bond. Well, they can always do money with the bonds if they have to print their own money to buy the bonds. Right. That's my point.
I think Greenspan even said that.
Yeah, that's not the problem. I don't see that happening. I just see such that as that gets worse, they're not going to do an austere program. So forget about that. They're not going to come in and say, we need to cut here, cut it. There's none of them, neither party. They haven't done that in 15 years. They don't even talk about it. But so what they'll probably do is keep on running the deficit, printing the money, hitting your dollar will become worse. It might stay where it is, but real. They'll go down, down, down. And I think that's why so many people are buying gold, Bitcoin, those sorts of things. They want a hedge in that stuff. But they'll still sell them. They just may be buying a lot of them themselves, is what will happen.
So the U.S. average weekly hours worked by Americans, it fell to 34.2 in September. That's the lowest in 14 years, outside of 2020 during the pandemic. Over the last 3 years, average weekly hours have decreased by 0.8, posting the largest decline in at least 20 years. So people are working fewer hours, and companies are reducing working time to avoid layoffs and cut costs. Also, the number of job cut announcements by U.S. employers, that hit about 175,000 year to date. That's 3 times higher than in 2022. And in September alone, firms announced 73,000 layoffs. That's the second highest September in 13 years. So the labor market is clearly deteriorating. Americans are taking part-time employment at a record pace. The reality is that many people are working multiple jobs literally just to fight inflation. So headline numbers seem to be deceivingly strong, Ted, in the labor market. In your analysis, what is this deteriorating labor market pointing to?
Well, what it really points to, Gary, is that if you look at the increase in jobs, it's government. If you go back the last 15 months, those jobs went way up. Everybody else's went way down. And let's face it, the government's never going to do anything as far as lowering work hours. If anything, they'll give more time off for nothing, And so what happens is you end up with a situation where people think, well, they're throwing us a curve. They're really not. All the jobs are creating in the government, and all the hours worked are declining in the private sector. And that's where you are today. But it's a soft private sector, regardless of what the government does. The private sector is soft out there.
So, Ted, in addition to these declining hours worked, there's many other metrics that are pointing to a weakening economy. Is it your expectation that the economy just continues to slowly deteriorate until the next round of fiscal or monetary stimulus is unleashed? Or is it that the economy, it's stable, it's solid, and the next round of Fed helicopter money is just not coming as many have anticipated?
Well, you're talking about the Fed. They would bring the helicopter money if your markets break down, because everything's about the stock market. I've watched this the last 10 to 15 years. It's all about the market. The economy is about the market. I mean, everything's about the stock market, and everybody's in the stock market. And so the Fed, I would say this, if you get that breaking, they know that will have a really negative effect on everything else. And so they would come to the rescue. On top of that, I think they right now are just looking at it and thinking, man, this inflation may run back up here, November, December, January, February. And if it does, they're sort of stuck between a rock and a hard place. That problem will be that you push longer than you should have with higher rates. These businesses can only take it for some, they can go a little longer, but a lot of them are really stretched right now. And I think they can cover debt for a while, but after a while, they start giving the keys back to these lenders.
I've got some questions here that is pertaining to the markets and this. So let's start here. U.S. corporate executives of the S&P 500 companies, they've been buying the least amount of stock since the start of the 2021 bear market. This has happened only 3 times since 2008 during the great financial crisis. As an investor, is this an important trend or signpost to heed warning to? What's your take on that?
Gary, I've watched that for many years, and sometimes it works and sometimes it doesn't. And when they go to extremes, real big extremes, buy side or sell side, and they stay there for a while. Now they just go down and dip and hit it one time for a few weeks and come out of it, it means nothing. But if they have to remember too that there's certain windows they have here, and it really has to do with when they can do things. But sometimes it works and sometimes it does. It's not something we would lean on. We obviously look at the investment over anything else, but it's a sign. I mean, you can look at it because, they're pretty smart. I mean, they know when to buy them and when to sell them because, they get plenty of stock anyway without doing anything. They just give it to them. So if you see them selling, that means that we probably want to take some off the table.
Yeah, and I mean, there may be some personal reasons why they're selling, but there's also maybe some inside softball, right, information there that they're aware of.
Gary, I've watched them for decades. They always have a reason. When you look backwards and they sold at the top, they'll always have a reason. They'll say, well, that was part of the plan, and da 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 da. It's the same thing with public people.
So, Ted, currently a rising share of the Russell 2000 have negative earnings. Mm-hmm. Companies with no earnings, weak revenues, weak cash flows, they underperform when interest rates stay higher for longer because they're not able to pay their higher debt servicing costs. In your analysis, what is this rising share of the Russell 2000 with negative earnings saying to you about the risks for them, unemployment, and the markets overall?
Well, that number's been high for some time, Gary, probably a year and a half, maybe 2 years. We don't buy a lot of stocks that are in that really small group, but I watch them. And, those are the kinds of companies you want to buy at the bottom of the market, typically after you have a lot of selling, because they get really, really cheap and you can make a lot of money in them. But right now, what's happening is if you look at the small companies, they weren't able to go out and do the big financings like the top 20 companies. Top 20 companies financed a lot of stuff at 1% and 2%. And so that really shored that up for them. The small companies, not as much. They weren't able to go out and do the same thing. And a lot of them are tied to banks or tied to investment companies where, they just don't get that same benefit. That's one thing. The second thing is the competitive nature of those small companies is aggressive today. Everybody's after the business, and it's one thing to be one of the big companies, the top 10, but it's another to be down in this group down here where you really have to watch because somebody's going to try to come along and obsolete you or knock you out, and that's just part of what goes on right now. But it's been going on for a couple of years now.
So on the Dow chart, you can draw a line from the top of the 1929 bubble peak all the way to the top of the dot-com bubble peak, and then to the top in 2022, and now once again hitting it today. It's been classified as that resistance trend line at the top there.
Mhm.
Currently, the Dow is now above this 125-year resistance trend line. The last time this happened was 1929 when it crossed over that threshold. And that was the only other time that it's ever happened. Do you expect the Dow to keep rising without any mean reversion taking place? Is this time different?
No, there's always mean reversion. I'll tell you, there's a great book out there. I've mentioned it before. John Kenneth Galbraith was an economist that wrote about the crash of 20, and he's written 2 or 3 things about 29, but he wrote a book called The Crash of 29. And it's a small book. You can read it real quickly. But I was telling somebody the other day, if you close your eyes and you didn't know he was talking about 29, you thought he was talking about, you'd think he was talking about today. All the same, everything's about money. The real estate market was hot as a pistol between 24 and 28. And then just all of a sudden, it was so big, it just couldn't work anymore. A lot of leverage. One of the things I always say to people is, look, if you look at the forward multiple right now on the S&P at 22 times, or the current at 27 times, it's way above the norm, which is, call it 15 times in our opinion. Well, if you have it at 22 times and it's 15 times, think about that. You're talking about 35% lower just to be normal, not cheap. And I think people rule it out. And I've gotten these comments back to me before from people that basically just call me out because they said, hey, you think the stock market is a risk asset, and it's not a risk asset. It's a long-term hold. And I kind of sent me one yesterday that said, hey, the market comes off 50%, but 2 or 3 years later, it's up about 150, 200%. You see the mentality out there? My point is nobody understands a elongated bear market because they've never gone through one. My first 8 or 9 years in the business, the market went nowhere but down. It'd go down to 750 and back to 1,000. You didn't make any money unless you traded. And then we had the same thing between 2000 and 2012. I mean, by the time you got to the end of 2012, the annualized return on the S&P, get a load of this, was 1%. People, I don't know if they have bad memories and you think, well, I can hold them long term, I can hold it. Believe me, 12 years is a long time.
Yeah,
I'm gonna test your mettle on that one to find out how long term you are, because I have a saying around here, all of our portfolio managers, everybody's long term till they're losing money, and then they're short term.
Well, you're in good company. John Hussman, I'm sure you know that name.
Yeah.
He put out back before the dot-com implosion that based on his analysis that the NASDAQ would drop 83%. And then it went ahead and dropped 83%.
Yeah.
And this time around, he's calling for a 50, I forget the exact number, but I think it's a 57, 58% drop.
Well, it wouldn't be surprising. I'll give you a little anecdotal story. One time back in the early part of 2000, I had a big trust officer that was, of course, trust officers, they stay in the market all the time. But he said to me, I said, look, I'm going to bet you the best dinner you can go anywhere in Texas. I'll take you anywhere you want to go if that the NASDAQ's going to fall at least 25% here. He took the bet. And then he came back and I said, tell you what I'll do. I'll double up. I'll do it. He said, no, we're going to do a 3 dinner bet on this one. I said, it's going to go down another 25%. And of course, he lost that too. But see how people get locked into these things. It's history. Whatever's been happening to me is what's going to happen in the future. And that's not the way this game works. And I think that's where they fail to understand that. Now, we're not into that sort of thing. But we are into finding companies that are cheap. And believe me, not many are cheap today. That's the problem.
So, Ted, the baby boomers' allocations to the stock market, I think you kind of touched on this a little bit earlier. They're incredibly high. The stock market's at all-time highs. The boomers, they haven't recalibrated their portfolios after the last few years of explosive growth in the market. I think there's some stats that I saw that they're about 65% allocated to equities, but at this stage of their life, they should be at about 35%. all the risk for them seems to be to the downside based on their allocations. They have the overwhelming majority of the wealth and spending power in the country. If they collectively experience a reverse wealth effect because of a stock market decline that's even more pronounced for them due to their allocations, what will the cascading impacts be like?
Well, it will be an economic problem, Gary, because what happens is these people, and that number is correct, by the way, it's about 65% of people over 65. We used to have an saw on Wall Street when I first went to Wall Street over 4 decades ago. It started in New York, and they had a saw that the amount of stock money you wanted was 100 minus your age. And so, if you think about that, that'd be about 35%. But what happens is now all of their real estate, like they have 2 homes, they're all maxed out. They think, man, we're rich on the homes. I made so much money in the real estate, which is really fleeting money. You can't get it out. But then they talk about their stock portfolios and maybe their rollovers from the big 401k, and they're all maxed out. And so, yeah, they're out spending money everywhere I go. I've had property in Wyoming for many years, 30 years. You can't even get in the place now. There's so many boomers up there spending money. Well, that's the kind of thing you get into where they forget about it, and they have poor memories. But believe me, if you were to get something like you talked about, a 50% sell-off or more, you talk about a fear level. These people then would be facing death at some point in the next 20 years. And it's a rough thing to face death and be broke. I mean, you don't want to do that. And so when I say broke, I mean, it cuts your spending back. But also think about this. They give a lot of money to the generations below right now because they feel good about it. They'll stop that. So you have a lot of things that can converge there. And I know they think it won't happen, but you always have economic cycles. I don't know when it happens, but for them to be at that level it's just not the right thing to do.
So today, investors and business leaders are pointing to the potential for generative artificial intelligence to be a new catalyst for the future. And according to some current research, AI could increase annual U.S. GDP growth between 0.5% and 1.5% annually over the next decade. That's equivalent to 1.2 trillion to 3.8 trillion in new economic growth. One Goldman Sachs report shows that AI-enabled labor could jolt cumulative global GDP by 7 trillion. It's not the first time such a trend has emerged, and it won't be the last. Historically, these periods of great change show how bubbles can be inflated around hype, hope, and hysteria. And given the current market conditions, do you believe that there's a risk of a market bubble forming, or one that's already formed similar to the dot-com bubble that could eventually burst and lead to significant losses? Or are we witnessing a new economic cycle that warrants much less concern?
Well, Gary, it always feels that way at the time, and everything is probably written today about. If I go back in 1996 and 97, and I have all the newspapers from this stuff, you go back and look at it, it will say all of these paradigms. Then they had a term, they used it for years on end, the new paradigm, the new paradigm. Hey, you guys are crazy talking about us. It's a new paradigm, all right? And no matter what we have to pay for these companies, a new paradigm. Well, if you go back to 24 or 25, 1924, the hottest thing going, had just come out, was like AI, was the radio. And Radio Corp of America, RCA, went from $1.15 to about $124 a share. Round tripped it, by the way, all the way down to $2 and never got past that almost till 42. If you go fast forward to Polaroid, 68, 69, 70, yeah. Polaroid is going to be the catch me out. Everybody had to own Polaroid. Everybody. Polaroid eventually went broke. It's not even in existence anymore. And then you fast forward, the next one was Cisco. Mm-hmm. And I remember people that had Cisco and had tremendous profits in it. And I tried to get them to at least sell part of it, get their money out, get a profit. They wouldn't do it. Stock went from basically a dime to 82, roughly on an adjusted basis. And back to $8. I mean, and it's still not 82 today. So there's always things like that going on. And you have to be realistic enough to know that when they pay up for those stocks and you pay those gargantuan numbers that you pay for, they're probably not going to be right. I'm not knocking AI. I'm just saying that we don't know enough today to know who really is going to make the money on AI. I think everybody wants to hang a shingle out and tell you that this is how it's going to work. But that in the end, it doesn't work that way. If you look at all the businesses that were spawned from the internet, the ones that made a lot of money, we weren't talking about in 98. You know, they came out later on. So we'll see. I mean, I use AI just to check it out and see if it works. And a lot of times it gives me bad info. But I always said, if you find out the company that can filter all and make sure everything's factual, that's a company you want to own.
So, I mean, you didn't say it directly, but do you think that what's happening now is another historic bubble?
Yeah, I do. I think people are all in. And when it comes around, and it takes a while usually for these to come around, then, you know, they'll look back and say, I don't know what I was thinking. You know, I had all the signs that showed us what was going on. But see, the greed button is so big that people hate to give up money. I mean, I've had people leave us because we didn't have a really, really big position in NVIDIA. I mean, okay, if that's what you're shooting for, that's great. But you have to really stop and think about what happens. But yes, I think it's a bubble, and I think I don't want that to be your headline, because I'm not predicting a crash tomorrow. But I'm just saying that if we're in a bubble, we're in one now, and everything though, except metals and commodities, everything else is a bubble.
Yeah, I think it's important for you and for everybody watching. You know, I'm not one of those sensationalist type people, so we want real factual information from the experts that we bring on. I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History nor Economics. This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Ted as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video.